What is up, guys? Welcome back to the trading world. Today I have a concept that was shown to me by my friend FA not even 2 hours ago. I think this is going to be a awesome video, and then I'm going to review the market afterwards. So with that, let's jump right into things and we'll review the market for today, which is Tuesday, August 18th. Cool. So the concept, I haven't officially named it. I don't know if FA has a name for it, but it's basically the idea that first of all, you have to know what a range chart is. Okay, so a range chart is interesting because the candles don't form based off of time. These candles, so this is on SB Pro X. It's a software you have to download, and I'll have to make a video explaining the whole software and how to download it. But a range chart is, instead of a normal time for each candle to form, whenever a candle moves out of a certain range, the next candle forms. So for instance, this is 100, a range of 100. I'm guessing 100 ticks. And so each of these candles are going to be the exact same size from high to low. And so basically the concept is using the range chart. Specifically, FA says to do a range chart of 100. That's just what's been working for him recently. That's, yeah, I mean, you could probably do whatever range chart you want, but 100 is pretty solid. Using this range chart of 100, you're gonna want to have pin bar that on the range chart that diverges with a pin bar, or with whatever the delta is. So if you don't know what delta is, I have a video on absorption and aggression. Highly recommend you watch that. But going back to SB Pro, okay, delta is basically, were there more market buys or were there more market sells within any given candle? For instance, here there were way more market sells within this one candle here. Here there were more market buys within this candle. Okay, so it's important because it tells us our orders getting absorbed, and in what way are they getting absorbed by limit orders. So okay, so if you don't know what that is, watch my short form video on absorption versus aggression. But basically, what you're going to be looking for here on the range chart is you're going to be looking for, for a short, you're going to look for a red pin bar. That's not the example I wanted to use. You want to use a red pin. You want to look for, if you're looking for a short, you want to look for a red pin bar on the range chart of 100 with a green delta. Okay, so red pin bar, green delta is short. Okay, that means it's a short, and you can see boom. So that's basically absorption. Okay, so red pin bar here, green delta leads to short. Okay, red pin bar on the range chart of 100, green delta, what happens? Leads to a giant short. Okay, and then the opposite is true with longs. So if you have a green pin bar with a red delta on the range chart of 100, that means longs. You can see boom, right? This one's not really a pin bar, but it's somewhat of a pin bar, right? It's more of, yeah, anyway. The concept still applies here, right? Green candle here, red candle here, and then what happens after? Expansion. Okay, so this is a little concept that I learned today. I wanted to share it with you guys. As I get more information on it and learn more about it, I will make a more in-depth video and a short form video, but just wanted to quickly make this. And yeah, let's just go into the market recap now. So hopefully you found that valuable. I'll try and do a short form video on that at some point. But yeah, range charts, it's, you know, something that I've never really thought about before, but it actually is kind of cool. So so what happened today? Well, overnight we expanded. London and Asia just delivered us lower, and if you just look at the chart, what is this? If I cut through candles, this is just a giant low resistant curve, okay? And you might be like, oh, that's hindsight. Well, not really, because I actually, I could go on Discord, and I could show you that I was looking at those to be low resistant lows yesterday night. Right? So this is something you can do with low resistant liquidity, is you can kind of cut through candles here. So you can see how this liquidity curve, if I cut through candles, it's just all this is low resistance, and then what happens on the other side of the curve, right? We cut through this low resistance liquidity as well. What else was here? Overnight gap, right? This is an amazing target, right? The market comes back and wants to fill these overnight gaps, okay? And check this out, right? Here's the overnight gap. What happened? Right as the market opened, we finally finished filling it, okay? So the market all night was seeking to fill this RTH gap, and upon the market open, this is something else that you'll maybe find interesting. Upon the market open, we get a cantina, so meaning outside bar on market open or news. So an outside bar is a candle which takes the prior candle's high and low. Anyway, so like this would be normally this, since this is right as the market's opening at 9:30, this would normally be my cantina kill shot model, right? Where you have an outside bar, so we have a candle which takes the high and the low of the prior candle, and then violently it doesn't have to close higher, but in this case it's violently closing higher. But why don't we go to run all these highs here? Because look, we have an unfilled RTH gap. We hadn't even filled it yet. And so the market, before it's even going to consider this cantina here, it needs to come down, finish filling the RTH gap, and, well, it was just so bearish and violently bearish that it not only filled the RTH gap, but it continued and ran all of these lows all the way down to these equal lows here. And looks like that, at least as of right now, that was the target, okay? These equal lows right there. So, right, so I was going to show you guys how I was looking at this last night. If it'll load. But basically what I was looking at last night is we had a time-based SMT with this high. So ES made a lower high, NASDAQ made a higher high. So let me get this pulled up and drag this over. So we have right here a previous 3 week SSMT. And yes, you can do that with 3 weeks, because every quarter, so from January through March 31st, is its own quarterly theory cycle. So each 3 week period is one quarter within the January through March 31st quarter, right? So this is a 3 week SMT. It becomes very obvious when I turn on this indicator, which is my quarterly theory indicator. Check this out, right? The high, and let's actually get side by side here, okay? Oh man, whoops. The high of this 3 week period, okay, is right here on NASDAQ. The high of this 3 week period is right here on ES. Then what happens? It's an SMT between quarters. So between this 3 week period and this 3 week period. So this is time-based SMT, okay? And you see how the time-based SMTs are the most sensitive? This is the high of this 3 week period. This is the high of this 3 week period. And I could, I don't know why it's not showing up here. Let me just copy this over, paste it, and then get rid of this, right? And then you can see we're also above the true quarter open, right? So SMT between this 3 weeks and this 3 weeks and this 3 weeks and this 3 weeks. and then delivery lower. If you want access to any of these indicators, you get access to all my indicators with my YouTube membership if you're interested. So just so you know that that's an option. But yeah, these are all my indicators that I've coded. And yeah, we went and targeted those equal lows. We reclaimed, so you'll note we have a daily gap, which honestly I didn't think was going to be relevant anymore, but we have this daily gap here. And you'll note we've already kind of used it, but sometimes this will happen where even when you've already used it, it will still hold in the future. This is what's called a reclaimed fair value gap, right? So this daily gap, if I drag it over, you can see that it's used again with our SMT with this high here. So let me draw this out a little better. So efficient, this is what I call efficient delivery of a gap, where you come up to the very tippy top of it, or not even just a gap, efficient delivery of a key level, efficient delivery of a PD array. When you come up to the top of it, fill it, and then go away from it. This is what I call efficient delivery. So this is our daily gap. This is our 3-week SMT, and then we expand lower. And once again, that's not the image I wanted to look at. Last night, I was looking at this, and I had marked out, we had the overnight gap, we had the low resistant lows, and I was like, this just looks like we're going to just start dumping overnight. And then you can see that's literally exactly what happened, right? And then we ended up going all the way to the final objective, at least right as of right now, which is the equal lows. We might continue down to this RTH gap. So, but once again, this is what I call a reclaimed gap. It might not be the official ICT definition, but I really don't care. It's just what makes sense, right? We've already used the gap once here, so we've already used it, and then we reclaim it, right? You see how perfectly we use it? You can't deny how perfectly we use that, right? So this is what I mean when I say a reclaimed gap, and you can see just how powerful it can be. Let's see if I can get this indicator here. You can see just how powerful it can be, because once we get this time-based SMT into the high of the gap, bang, we deliver lower. What's this on the hourly 2022 model, right? Because why? Because liquidity sweep, liquidity sweep, sweep of the high, break of structure, and retrace to the fair value gap. This is our 1 hour 2022 fair value gap, and it's probably right at OTE. Yep. What do you notice? 0.705 perfectly hit. Actually, I even drawed it out a little badly. 0.705 perfectly hit, and then delivery lower. So anyway, the actual market to trading this market was actually pretty hard, in all honesty, because you're having to deal with really high resistant liquidity. Because once again, if the higher time frame is expanding through these low resistant lows here, then the lower time frame is going to be high resistant, meaning people are going to think, oh, wow, we have to go run these highs. But no, this is a high resistant curve, meaning it's not, the market has no plans of coming to run these highs, because we're actually on a higher time frame run. And so then you have actually something interesting that I haven't talked about in a long time that happened today, which is my vol model. Where basically you mark out all the true opens, right? You have a high resistant curve. We even went above the low time from true open, and you just soup it. You just soup into the high resistant curve above all the true opens, and then it's basically just how to get in on it. Have you ever had it be where it's like the higher time frames expanding? You're like, how do I even get in on this move? soup above the true opens into high resistant liquidity. That's my vol model. Okay. Right, and then yeah, there's more interesting stuff about today, but in general, today was a pretty hard day, and genuinely, like, you look at stuff like this, right? There's an inversion for value gap here, just completely gets destroyed. Inversion for value gap is getting destroyed everywhere, and why is that? Because the higher time frame takes precedent, and we were running these low resistant lows here. So high resistant conditions can be very hard, but it's important to learn from them. So with that, hopefully you guys found this video valuable or learned something. I will see you guys in the next one. Peace out.